everyone, I am Ankit Soni, Fundamental Analyst at Mirae Asset Sharekhan, and welcome to Mirae Asset Sharekhan's Market Forecast for 2026. In this video, we are not revisiting what went wrong or right in 2025. We have already seen that. So what we are focusing on today is what changes as we move in 2026, and more importantly, why the market environment ahead looks very different from the one investors just experienced, along with our stock preferred picks based on our research. So let's break this down clearly and simply. At the highest level, India enters 2026 in position of strength. Economic growth remains robust, with real GDP expected to around 7.4% and nominal growth expected to be around closer to 10%. What's important here is not just the number, it's the quality of the growth. Inflation is under control, fiscal discipline is intact, and policy decisions are increasingly focused on long-term capacity building, not short-term market excitement. The India-US trade deal acts as an important confidence booster for markets, as sharply lower tariffs improve India's competitiveness and support exports, manufacturing, and supply chain diversification. Along with other recent FTAs, this strengthens India's growth visibility, reduces trade-related uncertainty, and improves the overall earnings outlook for companies linked to global demand. This combination creates a more stable base for businesses and investors going into 2026. Now let's talk about money, specifically interest rates and liquidity. The RBI has already cut rates by 125 bips, bringing the repo rate to around 5.25%. Policy is now broadly neutral, meaning we are no longer in a tightening phase. Why does this matter? Lower and stable interest rates broadly reduces borrowing costs, support consumption, improve corporate profitability, and make equities more attractive compared to the fixed income. Even globally, monetary conditions are easing, which improves liquidity flows towards emerging markets like India. This creates a supportive financial backdrop for current year 2026, even if volatility doesn't disappear completely. This is where the real story begins. Over the last year, India went through one of its longest earning downgrade cycles, with EPS estimates cut by roughly 12 to 15%. Historically, whenever earnings downgrade lasts this long, they tend to mark the bottom of the cycle. What changes in 2026? As demand stabilizes, the downgrade cycle will be stopping and earnings are expected to start recovering, especially in second half of financial year 26 and beyond. Markets just don't move on headlines. They move when earnings direction changes. And that's exactly what makes current year 2026 important. Let's now break this down sector by sector in simple terms. BFSI, the backbone of the market. Financials remain the foundation of the Indian market. Credit growth is recovering, asset quality is stable, and balance sheets are strong. While margins may face some pressure as rates adjust, the overall system is healthy. In simpler words, banks and NBFCs benefit when the economy grows steadily, and that's the environment we are heading into. We have our preferred BFSI picks. Those are Axis Bank, Aditya Birla Capital, and L&T Finance. Next sector is pharmaceuticals and healthcare. Defensive with a selective growth. Pharma and healthcare offer stability in 2026, especially in the market that is still transitioning into strong earning cycle. The sector benefits from steady domestic demand, export recovery, and improving regulatory clarity in the key markets like US. While pricing pressure in generics remain a watch point, better compliance, new product launches, and gradual normalization of approvals improve earning visibility. Healthcare also continues to benefit from rising penetration, aging demographics, and increased focus on preventive care, making it a relatively defensive but structurally sound sector in the year ahead. Here are our preferred picks from pharma and healthcare. Lupin, Divi's Lab, Biocon, Torrent Pharmaceuticals. Let's go on to next sector, which is cement. Cement has been quite but very consistent. Cement doesn't make headlines, but it directly benefits from infrastructure spending, housing demand, stable pricing discipline. So we see with input cost under control and volumes improving, margins are expected to remain stable through 2026. Our preferred picks in cement sector is Ultratech Cement. Now let's take another sector, which is consumption. Why spending should improve? Consumption gets support from multiple angles, which is tax reforms, lower inflation, better consumer sentiment. Urban demand remains steady, while semi-urban and rural demand could improve gradually. Companies with strong brands and pricing power are best positioned here. Our preferred picks include Radico Khaitan, HUL, Godrej Consumer Products Limited and Marico. Let's go on to capital goods. Capital goods is riding the investment cycle through government capex, private investment improvements and manufacturing picking up. Execution and order visibility remains the key here, but the long-term investment cycle is clearly in motion. Our preferred picks in cap goods sector are Larsen & Toubro, Cummins India, Polycab. Now let's move on to defense. Structural, not cyclical. Defense continues to be a long-term structural growth story supported by indigenization, policy support, strong order visibility. This is not a one-year theme, it's a multi-year shift. Our preferred pick is Bharat Electronics in the sector. Now coming on to valuations and market positioning. One important point before we wrap up. Markets today are trading at valuations that are around 20% lower than early 2025 levels. That significantly improves the risk-reward equation. In the near term, markets may still prefer large cap, high quality names, while small and micro caps may take longer to stabilize. But overall, the setup for current year 26 is healthier than it was an year ago. How to think about current year 2026? To sum it all up, 2026 is not about chasing momentum, it's about positioning for a turning earnings cycle, stable macros, supportive policy and sustainable growth. For investors, the message is simple: focus on quality, clarity and consistency. Thank you for watching.
Investment in securities market is subject to market risk. Read all related documents carefully before investing.